All right, let's broaden it back out because markets were mixed at the close with the Dow snapping 8 straight days of gains. But we do have big economic data on deck with the Consumer Price Index out on Wednesday. For more on what to expect, we've got Gus Faucher, Chief Economist at PNC Financial Services Group. Gus, it's good to see you. So we've been talking all about this anticipation for the inflation data. I know that you have been doing a lot of work on this and also work on kind of how the inflation data relates to the job market, how the Fed is viewing that. So put it all together for us. What are you expecting this week?
So we're expecting to see a 0.4% increase in the overall CPI from March to April, and then a 0.3% increase in the core CPI, excluding food and energy. That means we would see year-over-year core inflation slow from 3.8% in March to 3.7% in April. That's good news from the Fed's perspective, but the Fed does want to see inflation move even lower. And so I think we see the Fed on hold in the near term until they get more definitive proof that inflation is really slowing.
And Gus, how confident are you that we get back to the Fed's target in the next 6-12 months? And what needs to happen, Gus, for us to do that?
I think we need two things for that to happen. The first is that we need to see slower growth in housing costs. So when we look at measured rents, those are falling pretty quickly, but we haven't seen that show up in the shelter component of CPI yet. I think that will happen over the months ahead, and so we'll get some help there. And then I think we need to see a bit weaker wage growth. Wages are growing around 4% year over year. I think to get to 2% inflation, we need to see something closer to 3.5% wage growth. I do think with a bit softer job growth, with perhaps a bit of an increase in the unemployment rate, we will see slower wage growth. And given slower wage growth, given slower growth in shelter costs, I think we'll be back to that 2% objective by this time next year.
So what does that say about the Fed's ability to cut before this time next year?
The Fed doesn't need to see that inflation is at 2% to cut year over year. What they need to see is that inflation is moving toward 2%. Even if the Fed were to cut 1, 2, 3 times, monetary policy would still be contractionary. It would still be weighing on the economy, just not as much as it is now. So I think that if we do see the inflation numbers start to look a little bit better, we see that inflation is indeed slowing, then I think the Fed feels comfortable cutting, I would say sometime, let's say at the September and then again at the December meetings, 25 basis points each time.
So maybe September, Gus. I'm just curious whether you think, does it get tougher for the Fed to cut though, as you get closer and closer to the election, Gus?
I think the Fed will take into account the election, but I think if inflation is slowing, I don't think the Fed wants to wait too long. I think they're concerned about waiting too long to cut rates. That could increase the drag from monetary policy. So I think as long as we see better inflation numbers, the Fed will be okay cutting in September, and then they can cut again in December after the election.
Since you mentioned the election, we have to ask, how you think that's going to play into their decision making.
I don't see that as a big factor. I don't think the Fed is going to be cutting rates aggressively heading into the election. I think that would look bad. I also don't think the Fed is going to see any need to raise rates heading into the election. I do think that we'll see slowing inflation, and that will allow for cuts. So I think if the Fed cuts once this year before the election, I don't view that as a big deal. That's not their attempt to influence the election. That's just their attempt to stay on top of things. And I don't expect that that's going to deter them one way or the other.
Gus, switching gears a bit, we do have some big retailers reporting this week. Gus, got Walmart. We also have retail sales. I'm curious, Gus, to get your take on the consumer, how healthy and resilient the consumer looks, Gus, because we do hear this talk of, consumer frugality, consumers trading down. What are you hearing and seeing, Gus?
So we do expect to see a bit softer growth in retail sales in April. We had a very, very good March. So I think, we see retail sales up about 0.4%. If you take out autos, maybe up 0.2%. Some of that is higher gasoline prices. But I think consumer fundamentals are still very, very good. good job growth, good wage growth, slowing inflation, rising household wealth with higher stock prices and home values. The big drag is coming from higher interest rates, but overall, I think consumers are in solid shape and they will continue to increase their spending throughout 2024 and into 2025.
Gus, thank you so much for joining the show today.
Thank you.